Hey guys, Marty with Options Unleashed. Today we're going to cover Best Practices series, option strategies, the basic fundamental building blocks that you guys are going to use in trading options. I'm going to cover everything that you can probably put together in here, but then we'll have other videos on really deep dive into these, but I'm going to cover the option basics because I see a lot of information on the internet and YouTube, and a lot of people are giving you strategies to buy and get rich quick and buy options here and buy options there. And the bottom line is that you need to have like a basic understanding first of options. And I'm not going to go into, there's so much to go into with in terms of the structure of options, calls and puts, selling and buying, but also the option Greeks that we talk about that you've heard about. There's advanced strategies. There's the pricing and the different fundamental pricing of options and how some of the formulas work that I won't go into here. And also the different platforms that you can use, Thinkorswim and Tastyworks and Tastytrade and Fidelity and Ameritrade. And it goes on. And Robinhood now, right? And then, we have Bitcoin in there. So there's so many different things to know, but I think it's important to have the basic strategies and understand where the bulk of the option traders and pros are making money. They're not, I can give you a secret, spoiler alert, pros are not buying options, and they're not exclusively selling options. There's a reason there's a time when we buy and there's a time when we sell. And I can tell you some of these strategies that we'll cover today are not very popular. They exist because you can put together a call and a put, and traditionally you can put together, 4 legs, to make an option contract trade, but it doesn't mean you should. So we need to go over the basics, calls and puts. We're going to cover short puts, short calls, a covered call, straddles, short strangles, spreads, the iron condor you've heard a lot about probably, butterflies, unbalanced butterflies, calendars, diagonals, and some advanced strategies. So this is one of the parts in the series that I like to call for, option 101 and best practices. This is the option strategies, understanding how basic contracts works, the call, the put, and how we form complex strategies. And so we want to give you a good foundation for how these strategies work, because once you understand the strategies and when to apply these strategies, then you become a better trader. So some definitions first. The call put option or contract gives the option buyer the right, not obligation, to purchase the underlying security, a stock, bond, commodity. Today we'll focus on stocks, at a specific price and expiration from the option seller. So there's always two parties. There's a buyer. In this case, we're covering buying calls and puts. And then there's the seller, the entity or person that's going to sell you the option contract. And you have the right to buy it, to purchase the underlying stock at a certain expiration and price, right? But not the obligation. So you're not forced, at least, in the United States, you're not forced to actually take, physical stock, or, you're not forced to obligated to purchase the underlying security. This is a derivatives market on top of, that's why they call it a derivatives market. It really is, from math, like the first derivative. It's a derivative on the stock. So it's a completely separate market that derives its values from underlyings, but you're not obligated to buy those underlyings. You control one contract controls 100 shares of stock. That gives you leverage. You are typically, in buying calls and puts, you're optimistic about a price moving very quickly because there's an expiration. And then they can be in the money, and these acronyms you'll see: in the money, out of the money, and at the money. And we'll cover those shortly. And one thing interesting to understand is, and you'll hear this a lot, is in the money have an intrinsic value. And what that means basically is when you buy a contract that's in the money, it automatically can be converted to some value of intrinsic value for stock. And then these can be purchased, sold anytime, or as a hedge. So a short call option or contract obligates the seller. So now we're talking about sellers to sell the security to the option buyer at a strike price if the option is exercised on or before expiration. This typically, when we do short call just by itself, we're typically looking at a bearish view. We have undefined or unlimited risk. Whereas when you were buying a call option, you have defined risk. You put up a price for that contract that controls 100 shares, and it's defined risk. But when we short call options, or you've heard the term writing call options, they're the same thing. Those are typically undefined and unlimited risk. But that doesn't mean that it in the old days they used to scare the heck out of people. And probably people shied away, investors shied away from getting into the options market altogether because you were told that you were naked or you had undefined risk, and it's not as scary as you might think, although there are risks. This you also are, you have exposure to headline risk, acquisition risk, and there's much more risks versus a put option. So this is actually the scariest thing you can do because there are only really two vehicles, a call and a put, and then shorting or buying each of those. So you have, 4 different options here, on the basic contract that you can do. The short call option is the riskiest of the bunch because you're immediately exposed to acquisition risk and headline risk for the stock to go up, and you have unlimited risks to the upside. Can be purchased, sold anytime. If assigned, terminated, earlier expiration, the seller's contract will be called away and will be obligated to sell 100 shares. Thus, you are now short 100 shares at that stock price. So this is where your unlimited risk comes in. You now become short if you don't buy back your call by expiration. You can be assigned if you're in the money, and you are now short that option. You're short that underlying. So the short put option, a little bit different, but now this is the opposite of the short call. This obligates the seller to purchase a security to the option buyer at the strike price if the option is exercised on before expiration. This is a bullish view. It's undefined risk again. However, in this case, your risk is really still headline risk in the terms of a negative accounting and fraud and sentiment. So if people think that a certain security, in the past we had WorldCom or Enron or, you name it, any biotechs specifically or categorically biotechs, anything that's susceptible to headline risk in terms of fraud, accounting, sentiment, you have a huge risk, exposure. Can be purchased, sold anytime. If assigned, terminated early, the seller's contract will put the stock to you. So that's why they call it puts. You are put the stock, and so now you own that stock underlying 100 shares of that underlying at the strike price. So let's look at a graph of kind of, and you've seen this before, but what I try to do in my option series is give you a little bit more value here. So what I'm trying to show here is your classic graph of, it doesn't matter XYZ Corp, it doesn't matter what company you're looking at. This is a call option. The strike price is 135. This line here indicates the current price of 130. This is a out of the money call option that you go into, you buy, you're actually you buy to open the 135 strike. This graph is showing you that because you paid a premium for that, this red arrow is your defined risk that you purchased below this graph, right? So you've put up some amount of money, let's say $3. Now, because of that $3 premium, you need the stock to rise above 135 plus the premium you paid for it. So if you paid $3, you would need it to go 135 plus 3 to break even on the trade by expiration. Then the green arrow shows how much money you're making when that happens. The other thing I try to show is this curve is your what we call, your normal distribution that stocks follow. And this is your one standard deviation curve, if you will. Now, I don't really show any indicators here, but you can see how when you're buying in out of the money, when you're buying options, you're expecting a stock to go above, in most cases. In most cases, you're expecting the stock to go outside of that standard deviation, that one standard deviation, because you're expecting a profit from that stock. The person that sold you that stock wants the stock to close in this one standard deviation area up in here because they want to collect the money from you. So in general, when you're buying a call option, and this is why you hear that people can't make a lot of money just buying and selling puts and calls, and that's true, because if you buy them at the wrong time, your purchase price, your difference here of the premium you paid, just puts you at a tremendous disadvantage. And we'll show you examples later where, if you're paying $3 for this option and it just doesn't have any volatility, you're basically every day you have what's called theta decay, and the option seller is collecting money against you every day until that closes. So you need it to go to 135 plus the 3 just to break even. So if you put up $300, you need it to not only go to that 135 plus 3, but you need it to go at least $6 move to get at least a 2 times return, or a one time return on your money, a 1-to-1 ratio on your money. So this is why buying call options by themselves and buying put options by themselves are inherently risky. Now let's look at the bottom. Another, in terms of why is this best practices? I try to tell you when you would do this type of strategy, right? You're bullish on the stock for out of the money call. You have no intrinsic value, meaning that at a 135 strike, this is like a worthless. If it closes right, anywhere below that 135 plus the premium, it's basically worthless. So there's no intrinsic value, meaning you're not going to collect any premium on the underlying unless it actually closed above that strike price. So there's no immediate intrinsic value. The other thing is there's a delta of less than 0.5, and we'll get into delta in another video, but delta, basically think of it as probability. Spoiler alert. Delta is your probability of closing above or below a certain strike. So if the stock is at 130, the delta for that particular strike of a 130 would be like 0.5. A delta of a 135 strike would probably be about 0.4 or 0.37 or something like that, depending on the price, or depending on the actual implied volatility. That's another Greek. But the point is that once a delta, when a stock is trading and you're looking at the market, the delta right at the money is typically 0.5, because why is that? Because you have a 50% chance of it going up or down that day and closing that day. So every day, think of it like nobody knows what direction a stock will go. They follow random, Brownian motion. The stock market follows a normal distribution of random events on a daily basis, and all things equal. I'm sure there are people that will argue with me that it's not completely random or not completely Brownian, but the point is that the stock market on any given day is a random event. So that means that this price, whether or not it goes up by $1 or down by $1, at any given day, there's a 50% probability that we'll do one of those two things, and nobody really knows the outcome. So that's why the delta at the money is typically 0.5. Now, if there's a news event or there's some event happening in the future, that's where implied volatility and vega or volatility actually comes into play. And those numbers will be juiced, but that's a little advanced right now for this slide. And we'll come back. We'll get into vega and different things later, but just want to give you an idea of what all these terms mean, because you hear delta and you hear 0.5 and you hear 16 delta and you hear 10 delta and you hear all these numbers. It might be a little bit overwhelming for most option traders. But at the end of the day, as you get into this, when I first got into this, it was very complicated. About, let's see now, at least 10 years ago now. And after a while, it becomes, if you study it enough, it becomes second nature. It becomes like riding a bike. So then let's cover the next one. This would be in the money call option. Very similar, but you can see now there's a huge difference in this case where you're buying in the money because you have some intrinsic value in the stock. So let's look at an example. This is the classic Apple example, and this is real Thinkorswim strategy pricing power. And Apple was at the time trading at 130, let's say, give or take a couple pennies, and you have the out of the money call at 135. It's a price of $4.25. So its delta is 0.39, meaning it has a 39% chance of being in the money. So obviously less than 50%. It's a defined risk trade because you're putting up that $4.25 times 100. So you're paying $425 for this contract because you're controlling 100 shares. Your implied volatility is 30%, and that just comes from looking at the option chain that we really haven't discussed, but the option chain will tell you what the implied volatility is based on the volatility of an underlying and other factors, and that's called Vega. Another thing is you're expecting the price to go above that. Again, you're expecting the price to go above the strike price here plus the premium that you paid. So the break evens are going to be higher on this, right? Your break evens are 139. So you're expecting the price to be above that price in roughly 30 days. So that would be your call premium. Now, one thing to look at this curve is your theoretical price at expiration, profit P&L at expiration. The magenta shows you your current premium based on a lot of different factors, but mostly the current underlying, the current option, the delta, the vega, and the gamma. Like all the Greeks combined are in this Black-Scholes algorithm that shows you what price that you'll get for the option. If you were getting closer and closer to expiration, this stock, if it hasn't gone way up and if it hasn't gone above your strike considerably and outside of that one standard deviation move, you're really expecting it to be above 145 to make money on this trade. But if in this case, if let's say it doesn't and you're really inside this curve right here in the kind of the meat, if you will, of the curve, and its second derivative, is where the inflection point is, you're probably at your maximum point because what it's going to happen is it's just going to completely collapse into this blue line. And so this kind of gives you an idea sometimes of where you might want to take profits if you do have a profit. Because again, as this price moves up, you're going to be profitable on the option. But if you let it expire, what happens? You get theta decay, and the short seller now collects all that premium from you. So the difference between the magenta and the cyan is really the VIG is the premium that the option seller can collect from you, or the premium that you can actually end up having as intrinsic value once the price gets above your strike plus the option premium you paid for it. So it becomes intrinsically valuable, meaning delta will be greater than 0.5 once it goes above your strike plus your premium. So let's look at the out of money put option real quick. It's the same thing, but just in reverse order. You're buying a put option. Here you have a bearish view, out of the money, no intrinsic value again, less than delta point. It's less than negative 0.5 delta. So now when you hear on the street, you hear negative delta, you'll hear me say in a lot of my videos that I'm a massive negative delta or I have a delta neutral strategy. That means that we look at our portfolios later and we see of all of our trades, are we aligned? What do we have? Do we have a total sum of negative delta or a positive delta for our entire book or portfolio? That will tell us whether or not we're overly bullish or bearish in the market. And that's really important. to look at when you actually start combining these strategies in different securities. And again, that's an advanced strategy. We'll get into it, but it's important to understand delta, the most fundamental Greek in all of options trading. And it really all distills down to the first derivative of options. It's really tracks price movement, but really the best way to think about it is kind of like it's the probability of an event happening. And that's it. That's all it really is. People make it really more than it really is to be. It's really just a first. It's kind of like if you remember from physics class and you have your first derivative of speed and position is, your speed. Your first derivative is velocity. Your second derivative is acceleration. Your third derivative is jerk, and then snap, crackle, pop, and so on. The way you look at this is your delta is really your first derivative on price. That's how I think of it. It's kind of like it's really it's really the derivative on the price, right? How much a contract will move in relation 1-to-1 with the stock price. The second derivative would be your gamma, which is, how much the price changes, right, over time, which would be like, kind of be like acceleration. So like acceleration is your change in velocity. Your gamma would be your change in delta. And then vega and so on. So it's very similar to, there's a lot of mathematics and physics in here. And it makes sense because these are all priced using a Black-Scholes algorithm, and they're priced using Brownian motion. So you would expect, given all this data and all this mathematics, that a lot of it would kind of be applicable to physics and mathematics. But you don't need to know all that. You just need to know that delta is your expected probability of a certain price. So let's look at the in-the-money put option. The in-the-money put option is just like the out-of-the-money put option, but again, your strike is in the money, meaning you have intrinsic value. The stock can fall and you could still break even in expiration, but you're still looking for that move up, but you have a much better chance of when you're in the money, you're above that, your delta is already now starting to be greater than negative 0.5, and at expiration you'll be able to be profitable on that trade. So an example here on the Apple 130 out of the money put, again, where the stock is trading at around 130, and the out of the money put you buy that 125 put for. And the way we use the lingo in options is, you say to your broker, in the old days, we used to have to call the broker and say, I would like to buy the out of the money 125 April expiration, April 16th, 125 put for $4.20 limit. That would give you a limit order to buy this at that price at 125. And the delta in here, it is a negative 0.35. We have defined risk. The IV rank in this case is 31%. When I say not great, we'll talk about later in terms of like why IV rank is important. When you're buying options, you want that to be as low as possible, your implied volatility, and you're expecting the price to be that price of 125 minus the actual price that you paid for at 420. So you're expecting it to be lower than 120 and 3/4 or 0.75 by expiration. So that's how that works. And you're expecting, a big down whoosh in this stock. And again, the nice graded shaded areas in Thinkorswim gives you that one standard deviation move. So you're really expecting when you're a buyer of out of the money puts and calls, you're expecting the price to be near the edge of that. You're really expecting it to be in that one standard deviation move, because otherwise the option seller has got an edge on you. So they're expecting to sell options in this range, and you're expecting it to go way below those or way above those, outside of those values, because that's how you can really make. That's the only way you're going to make money on your trade. But again, typically you're not buying a call or buying a put by itself. So this isn't really a great strategy over the long term. You can't really make a lot of money using this strategy alone. But again, we're trying to show you the building blocks, if you will, because now we're going to start putting these together. Okay, so the short call is basically now selling, right, an option. And in this case, you're collecting a premium. And in this case, the price is 130, your strike is 135, so it's above the market. It's slightly out of the money. And we're taking a bearish undefined risk because you have undefined losses if the stock price goes above that 135 plus the premium you received, right, for the option. We want to use these in high IV, high probability of out of the money trades. And you'll typically hear something people say is 16 delta. That means that basically where the strike is for an option, it gives you about a 16% chance of being in the money for an option buyer, but you're selling it to that person. So in this case, it would be like an 84% chance of being out of the money at expiration. They're almost the same thing. You'll see on the platforms that there's an out of the money and in the money percent. Those are typically kind of used. I don't know the exact formulas, but those are very similar to delta. So one thing to just keep in mind is that delta is actually calculated. It's a number that can be calculated as a Greek, and it has a real value, whereas the probability of out of the money and in the money are usually taking delta into consideration. They're also taking volatility into consideration. And they're using a formula based on like 365 days of the year. So they're using slightly different formulas to calculate those. So some people go by 16 delta as the real one standard deviation move. And we'll talk about that later, why we use 16 delta in another video. And also maybe at the end of this video, we'll show you why we choose 16 delta. But just remember that the probability of out of the money, typically for short sellers with high IV, we typically look for that 84% as one standard deviation, but we'll go up to 90% in most cases. So an example is Apple's trading at 130. The short call of the 135, I'm going to go out of the money a little bit here. And our probability of out of the money, I want it to be higher. So here's an example, Apple trading at 130, the short call at 135. The premium received is going to be $4.10. We have a delta of -40. It's undefined risk, meaning we have losses all the way ahead of us if the price moves against us. We have an IV rank of 31%, not great for selling options. We're expecting the price to be at expiration 139. Break even would be 139 or lower, right, by 416. Obviously, we want it to be much lower, and you see that curve again. So let's look at the short put option, same thing, other way. We're expecting a bullish trade, undefined risk, high implied volatility. We look for a high probability of out of the money, like 84 to 90% being out of the money at expiration for that buyer. We want about a 16 delta, meaning we have a 16% chance for it to being in the money. So let's look at an example of the short put. It's Apple's trading at 130. We sell a short put at 125 for April 16th, about 30 days in the future. We collect $4.10. It's got a delta of 0.35, so it's positive delta. We wanted the stock to move up in relation to the price. And we have undefined risk, meaning unlimited losses to the downside, and we're expecting the price to be at least 125 minus the credit, which is 120 by expiration. Okay, so next is the covered call option, which I'm going to talk about briefly. It's a little complicated slide. The first thing that usually brokerage firms allow you to do is they allow you to buy right calls or covered calls. And that's because you're using your stock as collateral. So there's no risk. There's no risk to the really to the upside. So when you sell a call, there's typically risk to the upside, but because you're covered, you're using your stock as collateral to cover your losses. So let's just break this down really quick. The stock is trading at 130. You want to sell a call above that price, above the market, if you will, at 135. This dotted arrow in gray is the return that you would expect to get. And again, this delta right in here is equivalent to, it's going to be the price is going to be 0.5. The delta is going to go in line with the stock price, right? It's going to be a 1-to-1 match with the stock price. It'll be a 45-degree angle, most likely. But when you sell that call, all of a sudden your gains above that strike plus the premium that you collected start to get diminished, and the only thing you have at that point would be the gain from the premium. You always have a gain from a premium, so you'll hear that said a lot. Like a covered call, you will that's one of the things that's scary about a covered call strategy when you hear it, is that people tell you that you're guaranteed to make your premium, and that's true. The difference between this dotted line and this graph here is this distance is the premium that you collected on your call. So if the stock is trading at 130 and you just collected $3 or $300, so you had 100 shares of XYZ Corp at 130, and you sold a covered call at 130 or 135, let's say, and you collected $3 for that, you're immediately going to make $3. But the stock, as it goes down, you'll always have that $3 extra, but your stock and your delta is going to drop because you still own the stock. So you continue to lose. You can still lose money, but notice how your break evens have moved out by the amount of the premium that you made on the covered call. So you're guaranteed to make that $300. Although if the stock continues to go down 10, 20, 30%, you're still going to lose money. So it's not a perfect strategy, but it does allow people to, when a stock is trading very high and you want to take a break and you think it's going to fall, you can use a covered call strategy. There's a lot of different reasons. For tax reasons, let's read down here. We'll say there's protection. There's also, people use it as an income strategy. You can do this on an annualized, you can do this monthly or every 30 days, and then on an annualized basis, you rack up some serious cash doing this method. It's a neutral to bullish strategy, meaning that you don't want the stock to move up too fast to called away, but you also don't want the stock to drop because you'll lose money on your core holding. You're guaranteed that credit received that we talked about already. It's a high IV would be the ideal situation, which is pretty much around earnings trades, but that usually that allows a lot of risk because there's high volatility around earnings. So that means you can be called away really easily. And then you want to do it on low beta underlyings where the stocks aren't really moving that much relative to the S&P. That's about it on this. The covered call, because it's probably the first trade that people will do, kind of like it's the first trade you'll ever do when you learn how to trade options, but it's not the most sexy, I guess, option strategy out there, and it's not the most widely used, although I guess people do use it a lot for income strategies where you're kind of very low to moderate risk. So it can come in handy in that case. So now let's review, since you've learned a little bit about calls, puts, buying puts, selling calls, selling puts, and owning and actually doing something called a covered call. Calls and puts can be combined in various ways, up to 4 contracts typically, to allow the option trader to express a bullish, bearish, neutral, or even time-sensitive direction. All right, so on the bullish side, you can obviously buy a call, you can short a put, you can buy a call spread. We also call those verticals. You can you can buy a call butterfly, you can create a bull call spread, you can you can short or sell a credit put spread. You can buy a call calendar and diagonal, etc. So don't let all these terms like get in the way. These are just various ways to put a call and put together to be either bullish and bearish. And then you can also sell these neutral strategies, iron condors, short straddles, butterflies, and calendars. So the long straddle, you hear me say like strangle, straddle. Straddle is a different term, where straddle is a simultaneous long call and a long put that straddles a potential stock price. Typically, a straddle is at the money, what they call at the money strikes, where you go a certain width above the price and below the price, and you create that straddle. So you're straddling, meaning you don't care which direction it goes, as long as it moves above your strike plus your premium, plus the premium you paid, right? It's just like a call and just like a put, but you're combining them, and you don't care which direction it goes, but you're actually hoping for a highly volatile event. You're hoping for it to move way above this 1 standard deviation move. These aren't very popular, so be careful with these. When you first start trading options, people inevitably tell you that you need to sell covered calls. Boom, you're an instant option trader. The next thing is they tell you to buy a straddle. And boom, you probably lost on your first trade, or maybe you won. But the point is that these aren't very successful trades. Typically, the strategy doesn't work because there's so much premium down here that you're losing under this curve. Remember that this curve represents 1 standard deviation, and it's not to scale, but 90% of the time, or 68% of the time, you're going to lose on these strategies because you're kind of paying double the premium. So just be careful of that. So the call spread are actually a little bit more popular now as you get into option trading and you have some feel of direction now. Now you're getting excited about options, and you're putting some things to work that you've learned already. You've learned already how to buy a call, and you've maybe learned how to buy a call and sell a call. And so you want to put those two together to employ a call spread. So this would be a bullish strategy on low IV. And when we have a call spread, the thing that I've always struggled with when I first started selling and buying options, I could never remember what the different legs were and everything. And it's the best way to think about it is when you have a call spread, when you're buying a call spread, you're only employing calls. Okay. So you're buying a call, you're buying a long call, the 125 call at a certain expiration, and that would have, unlimited upside. But at the same time, you're selling a call at the 135, unlimited downside protection. So that's forming the call spread. And again, there's two calls. You're selling a call and you're buying a call. The difference between those two is going to be your profit at expiration. Okay, so let's just look at the other side of that, and then we'll get into some examples. The put spread is the exact opposite, and in this case, put spread, you're employing only puts. So you're buying a put at the 135, and you're selling a put at the 125. So in this case, again, low IV strategy, avoid earnings and events. For the most part, define risk, because the most you can lose is that the put that you bought. And it's a debit strategy. So you're going to be buying options. It's not going to be coming out of your margin. It's going to just come out of your cash account. And the debit is going to be the long put minus the short put. And it's going to have negative delta, meaning that you want the stock to fall in order for you to make profit. Let's look at the short call spread. So the opposite of a bull call spread or a bull spread would be a short call spread. And so the difference here is we're selling options and it's just flipped around. We're doing mostly selling, but we're also doing it at a high IV strategy. So on the short call spread, the strategy that you want to employ here is you want high IV, because you're going to be selling the 135 call and buying the 140 for protection. So you want your premium that you're selling, you want to be as high as possible. In this case, the shorter strike, the strike that's closer to the price, you want that to be high IV rank because you're selling premium. So that's going to be the most of your juice in here, your profit. But you're buying protection out at the 140, and again, the difference is going to be your profit. But in this case, your negative delta, because you want the stock to fall, and you're looking for 1/3. You're looking for a credit received of 1/3 the width of the strikes. So if it's a 135 to 140, you're looking for a credit of 1/3 the width of those strikes. So 1/3 of $5. So a short put spread is just the opposite of that. You're employing selling strategy. You put your selling hat on because you're selling that nearer strike price to the current price, and you're selling and you're buying the put that's further out of the money and for protection. And we call these the wings. When you're buying an option. So when you're buying a put or a call for protection, we call those buying the wings. And the protection that you get is you can't lose money, so you're defined risk. And just by very nature of being defined risk, you're kind of just, again, you're capping your losses almost like an insurance policy. So the best way to think about credit spreads, either long spreads or short spreads, is you have some kind of insurance policy, especially when you're selling. You're buying the wings as an insurance policy of a collapse, either to the upside or to the downside. So let's combine the two now in the famous iron condor that you've heard about. An iron condor is typically also called the short iron condor. There's different names for it, but essentially what an iron condor is now is putting together two of the strategies that we just talked about, the short call spread and the short put spread. And again, both of these have the same characteristics of their cousins. So we want it when you're selling a short call spread, you want high IV rank or high implied volatility. And when you're shorting or selling a put spread, you actually want that high IV and high implied volatility. And and again, an easy way to think of this, again, to not confuse yourself with calls and puts all over the place. When you're just looking at this piece over here, this is a short call spread, and it is made up of calls. You're selling a call and you're buying a protection. You're buying insurance. And on the other side, you're selling it put for a massive premium, hopefully. And again, that high IV strategy. And then you're buying the further out of the money strike for insurance purposes, and that's the wing. Typically, there's a well balanced, meaning the width of these strikes are typically the same, the difference in strikes are the same, and they yield the same amount of premium on both sides, and it looks essentially like this iron condor, named after the bird, the condor, and you can see in here this one standard deviation move. We're trying to be within that large area of that one standard deviation move because we are option sellers. So we want theta decay to take over. The price is at 130. We would love it for a theta decay to take over and just close right in the same value, right where it started, to have no volatility whatsoever. So typically we employ these with high volatility, and hopefully high volatility moving down to lower volatility. Typically, we look for implied volatility to be 60% or more. It's very difficult to do, but these are typically at least earnings trades. That's like a classic example, but you can find high implied volatility in a number of stocks. You need to use a scanner, or you need to just follow. And again, that high implied volatility, you can find implied volatility in a number of stocks. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just follow. You need to use a scanner, or you need to just fol a list of stocks that you're comfortable with and look at the IV rank and use the tools like Thinkorswim, Tastyworks, follow people, and you start to learn different volatilities out there. And then you can decide, and after a while, it actually becomes second nature. When you start collecting, $3, $4, $5, and, depending on your outlay, you start to understand, you start to remember, like, okay, this is a good deal or not. If you're collecting 50 cents for an iron condor, it's probably not a good deal. We try to look for like at least $1 when we're doing iron condors, and we'll get into why later in a future video. So the short strangle now is a little more advanced strategy in that it requires a little bit more margin, larger accounts, and we'll get into why in a second. But we talked about the iron condor buying the wings for insurance. It's basically an insurance policy in case the stock goes against you, right? So, but what happens when you don't have insurance? When you don't have insurance, you take more risk, and that's what the strangle is. But because you take more risk, you got more money in your pocket, right? A short strangle is just two strategies again. You're selling a call, and you're selling a put. You have fewer legs, so there's only two legs. You're collecting more premium. You still have a high volatility strategy where you want to sell high IV going down to low IV. You're expecting an implied volatility crush, but it has huge and higher margin requirements because you're exposing yourself to upside call risk and also downside put risk. When you're selling options, you have to look at the risk of every single strategy that you have on, every underlying. So if you're selling an option on a high beta stock, that's under $100 and it has a probability of being acquired, in the next 30 days, and your option is 35 to 45 days, you're putting yourself at a tremendous risk to the upside. So that's where you might want to employ an iron condor strategy. If you're selling option premium on indexes or ETFs or extremely large stocks like Apple, Microsoft, Facebook, and ETFs like the spiders, you can go ahead and trade and sell strangles all day long because there's no effective buyout in a SPY or IWM. So the call butterfly, very classic one that's employed a lot. This is the standard call or put butterfly in this case. It doesn't really matter, but when you're buying a butterfly and you're buying calls, it's made up entirely of calls. And when you're buying a put butterfly, it's made entirely of puts. Now, typically, when you buy a call butterfly, you're buying it that's somewhat, if you expect it to go up, you're buying calls, and if you're expected to go down, you're buying puts. But you can change that around. There's always an exception to the rule. But in this case, what's going on here is it's a neutral IV strategy. Neutral to moderate IV. It's defined risk because, again, we have an insurance policy, again, that we talked about. So we're protected on the wings, if you will. And we typically use this in bullish calls or bearish put examples. So this slide isn't that great of an example, but because the price is right in the middle. In this case, we want the price just to stay right at 130. And since you're buying the premium, you just want it to decay and, you want it to close in here. But typically what will happen is if the price is up in this area, you'll buy a put butterfly and you want the stock to go down and close in that area. If the stock is down here near 100 and you want to buy a call butterfly, you'd want that stock to move up at expiration. And your theoretical maximum will be in this area under the triangle. Butterflies are interesting because what you're effectively doing is it's the same thing as an iron condor, but the strikes, if I take the 100 and 160 strike and I combine them to 130, it's essentially the same thing as selling a call spread, selling a put spread, but the actual strikes of selling the option at the call and the put are the same. So in this case, you're selling two calls or puts at the one strike, and then you're buying the wings for protection. So it's still 4 legs. You've got a long call or a put debit. You've got a short call or a put debit. And then you've got one long call put debit as your protection. So in this case, you're selling 2 of the 130s. You're buying in a 160 and you're buying 100. And that's your call put butterfly. We use these strategies a lot, but what I'll show you in the future, where we start to bring in these wings to different levels, and you'll start to get into what's called broken wing or unbalanced butterflies. So here's a broken wing butterfly, which is used a lot. And this is the classic broken wing butterfly, but I'm going to show you guys in a future video how I use a slightly different variation of this as I consider it maybe a bullish or bearish broken wing butterfly. I don't really have a name for it yet, so curious to what you guys think in the comments. But in a broken wing butterfly scenario, let's say the stock is 130 and your strikes are, your middle strike is your short call put is, let's say in this case, you're short the 125 put, and then you buy protection, but you're buying protection for a strike that's not as far out in the future. So your strikes in this case are closer in. So this is you're buying a protection that's closer in, and then you're also buying protection that's further out. This is what's called a broken wing, as it looks like a bird that's got a broken wing. It's basically a broken wing or unbalanced, in this case, put butterfly. So we want the stock to come down slightly, close at that 125 level for maximum theoretical profit, but we start to lose money and start to get losses below our break evens. Adjusting the wings and your protection to determine how you want to position the trade. So this will give you no risk to the upside, which is ideal, but you only have risk to the downside. So in this case, you might be targeting a stock that maybe is on a technical basis, it's going to come down and touch a certain area, but it's not going to go any lower. Or you think that enough bad news is in the stock and you think it's going to go higher, so you're just trying to collect some juice in here in the event that the broader market goes lower. There's various reasons why people employ a broken wing butterfly. It's all just a matter of taste in this case. Now that you understand the basic strategies, let's review best practices for putting these together. Remember that we tend to sell premium when current implied volatility is elevated. A lot of people, Tasty Trade, Tastyworks, my buddies Tom and Tony, they employ a strategy of greater than 60%. That's kind of hard to do, in various markets, especially when the S&P and the VIX is low. But nevertheless, you try to sell sell premium when implied volatility is elevated, and we tend to buy premium when implied volatility is low, at 30% or lower. And the combination of those two strategies is going to keep you guys at maximum profit. So when you hear people telling you about the wheel strategy and selling calls and then selling puts and then selling calls and selling puts, that strategy might work, but you're kind of you're building an inefficient strategy in my mind. I don't use the wheel strategy. I know what it is, but what I do is I tend to look at volatility, delta, factors, earnings, expirations. I look at buying power reduction. Watch some of my videos on buying power reduction, risk, volatility, and then we're trying to build portfolios. We're trying to build beta weighted portfolios and beta weighted delta strategies. Those things are going to be way more important than trying to have a wheel strategy where you're just kind of doing almost like a mechanical thing, but think of it as like an engine that's running on very low oil. It's not very lubricated. It's not very efficient. So think of the wheel strategy for what it is. It's like a wind turbine. Whereas think of the strategies that we gave you in terms of selling when volatility's high and buying when it's low. Think of that more as a highly efficient, engine. Let's just review a couple of the factors here. That remember also that we want to enter high probability of profitable trades. We need to take into consideration a couple things. We need to take into consideration position size. That is, how much of a position are we taking relative to the other underlyings in our portfolio. We talked a little bit about delta and beta weighted delta for your entire position, all your positions, and buying power and things like that in another video. So please check that out. But position size is very important to not get burned and not get hurt. We talked a little about iron condors versus short strangles in terms of protection. We also talked about the current IV, the implied volatility is going to help you decide whether or not you're selling or buying. You also need to take into consideration, though, you just can't blindly go and sell premium 35 to 45 days out. You need to understand whether or not you have an earnings event coming up. Is your expiration, does it cover an earnings date? Meaning, does it expire after the earnings date? Or is it close to the earnings date? So one of the things I try to do is I try to make sure that when I'm selling premium, I want to get those expirations to either close well in advance of those earning dates so I can put on maybe another trade, or maybe make sure I cover those earning dates with plenty of time decay on my hands, because when there is an earnings event, that implied volatility is going to be high. So typically we try to just avoid earning dates altogether, because earnings dates have their own kind of special play, if you will, that we'll talk about in how to trade earnings with options. Another thing you look for is the trade's probability of profit, the delta, the theta, and other Greeks. It's important that we just don't sell or buy premium, that we have to understand, again, besides the position and the implied volatility, what is the probability of profit, right? So how far out are we going on this one standard deviation curve? Are we selling credit spreads that give us an 84% chance of being out of the money, or 16 deltas in that case, or even all the way up to a 95% chance of being out of the money, or 10 deltas? What is the strategy that we're employing? Because that will give us more probability of profit. It might give us less profit, but it will give us a higher probability of profit. And then we also have to take into the overall, we talked about this, the overall delta position of the portfolio. And then lastly, and not really lastly, but market conditions, the technical analysis, fundamental analysis, and the sentiment of the trade. So advanced option strategies, let's just review some. You saw the unbalanced butterfly. There's also something called a back ratio. There's bullish and bearish broken wing butterflies. There's a risk reversal trade. We can talk about adjusting short strangles. There's zero risk butterfly strategies. So another thing that we can cover in future videos are earnings plays, short premium income strategies. How do you make adjustments to your trades? We can talk about zero risk butterfly strategies and low IV strategies. So that pretty much wraps up the video. And actually, it didn't cover call diagonals and put diagonals, which is one of my favorites. So look for a future video that I'm going to follow up with you guys on this, and we're going to get into some of my favorite new strategies. I trade a lot of call diagonals, put diagonals, jade lizards, but primarily a lot of strangles. That's why I really love this slide right here. And that if you can learn any one thing from this video, other than the basic calls and puts, and when you start getting into your advanced strategies and you're a little nervous, one of the things to remember is it's all, a lot of it's probability. When we talk about things like one standard deviation or 16 delta, it's important to have just like a visual, what all this talk is of probability of success and why people are using this. What does 68% of the population have to do with trading, and what is the 16 delta and all that? And it really kind of just distills down to this simple standard normal distribution with a standard deviation graph. And if you take anything away from the video besides calls and puts, is that this just gives you a mental framework for how we really trade. If you want to take a visual of what we really are trying to do with short strangles, is that we're trying to cover that that one standard deviation at least. So the best way I try to use this. So one of the things I try to visualize for myself is this normal distribution, graph that you see from Statistics 101. And it can be confusing and daunting at first, but the way I try to apply it to options trading, and I think people just forget, it all comes down to this normal distribution curve. And while we talk about things that are 16 delta or 84% chance of being out of the money, is that remember that inside that one standard deviation captures 68% of the population, and stocks will tend to fall in this normal distribution, right? 68% of the time they'll be within that one standard deviation at expiration. And so option prices are priced based on this rationality, I guess, if you will, using the option Greeks that we talked about. And without getting into all the details, there's a reason why option prices are priced the way they are. But the point we're trying to make here is when you hear like a 16 delta, why do we call it 16 delta? And that's because 68% of the population will be within that one standard deviation, but 100 minus 16 is 32. So 32 would be outside. But then if you take the 32 and divide it by 2, you really have a 16% chance of it being above and a 16% chance of it being below. And so that's where your 16 deltas come in. And so what we try to do when we're selling options, we at least one standard deviation of probability of success. But when we do earnings trades, I even like to go out further to like 2 standard deviation moves, which would give you, you have to go out even further to like a 90% or 95% probability of being out of the money, meaning that an option buyer, is looking to buy options that are 2% in the money or 5% in the money, I'm sorry, for that leg, but you're selling options that are 95% out of the money. You're giving yourself many occurrences at a 95% chance. You can't get that probability in any other facet of investing or gambling. There's nowhere else you can actually trade this type of probability where you can trade over and over again a 95% chance of success. So hope you guys liked the video, and I'm going to do more deep dives on jade lizards and call diagonals and put diagonals and earnings trades and why 16 delta. And you can find my Discord at my Options Unleashed YouTube channel in my About page. You can also find my Discord in my Twitter account. Follow me at Options Unleashed. Join the discussion, get into options trading, and make the community a success. So thank you for watching. Have a great weekend.